What if I told you there's a crypto protocol that lets you take out a loan and never have to pay it back yourself? No monthly payments, no interest charges, no risk of losing your collateral to liquidation. Sounds too good to be true, right? Like something from a crypto fairy tale? Enter Alchemix and its native token ALCX, the DeFi protocol that literally turns your future yield into money you can spend today. We're talking about self-repaying loans, and after a massive 140% price surge in November 2025, this project is finally getting the attention it deserves. By the end of this video, you'll understand exactly what Alchemix does, why it's different from every other lending protocol out there, and whether ALCX deserves a spot in your portfolio. Let's get into it. Alchemix is a DeFi protocol that launched in February 2021, and it introduced something truly revolutionary to the crypto space: self-repaying loans. Now, I know what you're thinking. Self-repaying? How does that even work? Let me break it down. In traditional DeFi lending, think Aave compound, you deposit collateral, borrow against it, and you have to actively pay back that loan plus interest. If the value of your collateral drops too much, boom, liquidated, gone, painful. Alchemix flips this entire model on its head. Here's how it works. You deposit collateral, let's say ETH or a stablecoin like DAI. Alchemix lets you borrow up to 50% of that deposit as a synthetic asset, ALCX or ALUSD. But here's the magic. Your original deposit continues earning yield through strategies like Yearn Finance. And that yield? It automatically pays down your debt over time. You're essentially borrowing from your future self. The yield your money would have earned anyway is now paying off your loan while you sleep. And the best part? No liquidations. Because you're borrowing a synthetic version of what you deposited, there's no price fluctuation risk. If you put in ETH and borrow ALCX, the ratio stays stable. Your loan can't get margin called. Alchemix was founded by a team of pseudonymous developers led by someone known as Scoopy Trooples. And yes, that's their actual alias. They came out of eGirl Capital, a VC fund known for backing innovative DeFi projects. When Alchemix launched in February 2021, it was during the absolute peak of DeFi Summer 2.0. The protocol exploded onto the scene, accumulating over $1 billion in total value locked within just 2 months. That's insane growth. The ALCX token hit an all-time high of around $2,066 in March 2021. Back when DeFi was the hottest narrative in crypto, but like all crypto projects, Alchemix faced its challenges. Shortly after launching their ETH vault in June 2021, a bug allowed users to withdraw their collateral without repaying their loans. The protocol lost over 2,200 ETH. It was a crisis moment. But here's where the team showed their character. They launched a campaign asking users to return the funds in exchange for NFTs and ALCX rewards. And guess what? They recovered more than half of the stolen ETH. The community stepped up. Then in July 2023, Alchemix got hit again, this time through the massive Curve finance hack that exploited a VY-per compiler bug. Alchemix lost about $13.6 million in the attack. But once again, the story had a surprisingly happy ending. The hacker returned all the stolen funds after the team offered a 10% bounty. The attacker even sent a message saying they were returning it not out of fear, but because they didn't want to ruin the project. Let's get a bit more technical. Understanding the mechanics is crucial if you're considering using or investing in this protocol. The core smart contracts are called alchemists. These handle your deposits, issue the synthetic assets, and manage the yield strategies. There's one alchemist for each synthetic asset, ALUSD and ALETH. This is the secret sauce that maintains the peg of synthetic assets. The transmuter lets you exchange ALUSD for DAI, or ALETH for ETH at a 1-to-1 ratio. Yield flows into the transmuter and gets converted to the underlying asset, which then gets distributed to users who've staked their synthetic assets there. Your collateral doesn't just sit there. Alchemix deploys it to battle-tested yield protocols like Yearn Finance to maximize returns. The protocol takes a 10% cut of the yield for its treasury, and the rest goes toward paying down user debt. Let's say you deposit $10,000 worth of stablecoins. You can borrow up to $5,000 in ALUSD. That's your 50% loan-to-value ratio. If the yield strategy earns 10% APY on your full $10,000 deposit, that's $1,000 per year going toward your debt. In 5 years, your loan is fully paid off without you lifting a finger. And during those 5 years, You had $5,000 to invest, spend, or do whatever you wanted with. You borrowed from your future self. Now let's talk about the token itself, ALCX. ALCX is the governance token for the Alchemix protocol. It gives holders voting power on protocol upgrades, parameter changes, and treasury allocation through the Alchemix DAO. There's a maximum supply of about 3.1 million ALCX tokens. Currently, around 2.5 million are in circulation. The emissions have tapered significantly to about 2,200 tokens per week. That's only around 6.75% annual inflation. This reduced sell pressure has been positive for the token's stability. Alchemix adopted the vote escrowed tokenomics model made famous by Curve. Users can lock their ALCX for anywhere from 2 weeks to 2 years. Longer locks mean higher rewards and more voting power. There's even a rage quit function if you need to exit early, but you'll pay a penalty. 10% of all yields collected by Alchemix vaults goes to the DAO treasury. ALCX holders vote on how those funds get allocated, whether for development, partnerships, or other initiatives. Now let's address the elephant in the room, the massive price action we've seen recently. In early November 2025, ALCX absolutely exploded. We're talking a 140% surge in just 30 days. On November 5th and 6th alone, the token pumped over 120% in 48 hours. It briefly touched $20 before settling back down. So, what's driving this? A few key factors. In August 2025, the team announced Alchemix V3, a major protocol upgrade. This is huge. V3 introduces up to 90% LTV ratios, up from 50%. That means you can borrow significantly more against your collateral. They're also launching meta-yield tokens that simplify yield strategies and fixed duration redemptions that stabilize the ALUSD and ALETH pegs. The mainnet launch is expected in Q4 2025. On November 4th, 2025, Biconomy listed ALCX/USDT, bringing fresh liquidity and visibility to the token. New exchange listings often catalyze price movements, and this was no exception. There's been renewed interest in DeFi as a sector, money has been flowing back into established protocols, and Alchemix, with its unique value proposition, is catching that wave. Transaction volume hit 3-year highs, and exchange balances dropped over 35%. That signals strong accumulation. People are buying and moving tokens to cold storage, not selling. So, what's next for Alchemix? The roadmap is packed. This is the big one. V3 brings the 90% LTV ratios, meta-yield tokens, and improved peg stability mechanisms. The protocol completed a $50,000 security audit competition in May 2025, so they're taking security seriously. The DAO passed AIP 121, updating the budget and governance framework to prepare for fully on-chain governance. This means more decentralization and community control. Alchemix already operates on Ethereum and has expanded to Arbitrum. In July 2025, they migrated from Connext to Layer 0 for cross-chain bridging, improving security and flexibility. More chains are likely coming. In September 2025, Alchemix became a founding partner of the Tokenized Vault Foundation, helping steward important DeFi standards like ERC 4626. This positions them as thought leaders in the space. So here's the bottom line. Alchemix isn't just another DeFi protocol. It's genuinely innovative. Self-repaying loans with no liquidation risk is a powerful value proposition that no one else has truly replicated at scale. The project has survived 2 major security incidents and came out stronger each time. That's rare in DeFi. The team is committed, the community is active, and V3 could be a major catalyst. But let's be real about the risks. The token is still down significantly from its all-time high. Exchange delistings in mid-2025 showed that liquidity can be fragile for smaller DeFi tokens, and yield rates fluctuate. If yields drop, loan repayment times stretch out. As always, this is not financial advice. Do your own research. But if you're looking for DeFi protocols with genuine innovation and a clear use case, Alchemix deserves to be on your radar. If you found this breakdown helpful, smash that like button and subscribe for more deep dives into the most interesting projects in crypto. Drop a comment below. Are you bullish or bearish on ALCX? I'll see you in the next one.